Home prices, as you can see on this graph, are falling in the United States. They may not be falling where you live, but across the country, on average, over the first 6 months of the year, home prices are down modestly. And this is despite the fact that we've seen a drop in interest rates over the last 2 years. That tends to be an indicator that home prices may be going up, the housing market may be heating up, but that hasn't happened. We still have a low inventory of unsold homes, and we have somewhat lower interest rates than we did a year and a half ago at the peaks, but we still just haven't seen much of a pickup in home sales or in home prices compared to where they were, say, in the late 2010s. The question is whether this is good news or bad news. Is falling home prices good because it makes houses more affordable, or is it bad because there are other economic consequences? One of those things is, from the perspective of builders, falling home prices are certainly not a good thing. Price changes tend to lead construction growth by about a quarter. So if you have falling prices today, that means that construction growth is likely to fall in the next couple of months. And construction growth has already been negative for years. Even before the prices of homes started to fall, it's hard to be optimistic looking at this graph that that blue line is going to tick above zero and that home construction is going to turn positive again when you have the black line moving down, and again, leading that blue line in general over the past several decades. Home builder sentiment, as you might expect, given the environment we're in, is about the worst it's been outside of the housing crisis in the late 2000s. From the perspective of the buyer, I mentioned earlier that interest rates have been falling, but this chart shows how high they still are on 30-year fixed rate mortgages compared to the years of ultra cheap mortgages, financing and refinancing. You can see that that was true post-COVID. It was also true before COVID. We just had lower interest rates in the United States, and it was just easier to finance home purchases. So this has probably kept potential home buyers and homeowners who might want to sell their homes and move on the sidelines. So overall sales have been depressed. Mortgage demand has picked up a little bit, but not much, as you can see on this graph, which is one thing keeping the prices under that downward pressure. Home sales are a reasonably good leading indicator for future consumer spending. If you buy a home, anybody who's bought a home knows you tend to buy stuff to fill it up, and you tend to hire people to do work on it. And all that economic activity isn't happening to nearly as great an extent today because we just aren't seeing that volume of sales that we normally would. Home construction is also a good leading indicator for future economic growth. It tends to contribute the most to overall GDP early in the economic cycle. And it's hard to argue that right now that the US is early in the economic cycle, although housing has been in some kind of recession now for 2 going on 3 years. Right now, builders just don't have as much of an incentive to start new projects, and we're seeing that in the building permits and housing starts data. Home buyers are finding it hard to find the homes they can afford, even after the modest price declines. So how is this going to end up? And I'll show this last graph here and close this thought. Unfortunately, the current environment is quite similar to the one in the mid-2000s. You can see on the far left at the start of this graph. Affordability was a huge challenge then. Obviously, home prices had risen a lot, and home ownership began what ended up being a decade-long decline. Even as affordability improved, that black line was moving up, home ownership rates were declining. And even though interest rates were very low as well, prices took some time to find a bottom and then start to increase again. We are not set up for a resumption of 2008. Hopefully that comes as some comfort, particularly as it concerns the systemic risk that housing presents to the economy and the financial system. But we are concerned that without a meaningful drop in interest rates, which doesn't seem really to be on the horizon, it seems like it will be hard to generate lower mortgage rates, even with Fed cuts at the very short end. That means we're going to need to see home prices decline further, which is not going to encourage more building, or we're going to have to see a booming in construction, which doesn't seem like it's happening right now, certainly in and of itself on its own. The former, the declines in prices from here, seems likelier than the latter, which would be the construction boom. That's our thoughts. We have more thoughts at newedgewealth.com on housing and all other topics. Really appreciate you tuning in, and we'll see you soon.